Uh, Good morning, ladies and gentlemen. My name is Prashant Ruia, Vice Chairman of Essar Energy, and I would like to welcome you to today's presentation of Essar Energy PLC's first half-yearly results for the financial year 2010. Joining me today in London is Naresh Nair, a CEO for Essar Energy. Naresh will be making some prepared comments with me, as will Jerry Bacon, our CFO. Also joining me today on the stage is KVB Reddy, Executive Director of our Power Business, and Mark Lydiard, our Head of Communications. In the audience, we also have V. Suresh, CFO of our Power Business, and Sampath, who's currently CFO of our oil and gas company. But as you will have already read this morning, is taking over from Jerry as CFO for Essar Energy at the beginning of September. They will be available to assist me with questions at the end of the presentation. I would like to start with an overview of our key achievements from the first half, the main one which was, of course, our IPO, which raised net proceeds of US $1.85 billion, which are being used to finance both our power and oil and gas projects. We are delighted with the outcome, including our entry into the FTSE 100. We still very much believe that we offer investors a unique window to the Indian energy market through a large liquid London-listed vehicle. In power, we saw a solid operating performance with good availability throughout the period. In terms of our projects, all of our Phase 1 projects are currently on schedule and on budget, and Naresh will take you through some of those details. We have also made significant progress since the IPO on our Phase 2 power projects, including having financial tie-up for 9,670 megawatts of the 11,470 megawatts of power under construction and development. This includes a US $800 million of debt for the first phase of the Nav Bharat project, a 1,050 megawatt coal-fired project that we acquired last month. I would expect a number of our Phase 2 projects to move into the construction phase over the next 6-month period. Last but by no means least, our Vadinar project, which is a 380 megawatt gas-based power project in Gujarat, is now in the final stages of commissioning and will enter commercial operations as promised this quarter. In exploration and production, we signed production sharing contracts for 4 coalbed methane blocks that we won in the government's latest round, including the 4.7 TCF Rajmahal block in Jharkhand. This award means that we now have over 10 TCF of coalbed methane gas resources in our portfolio, making us the largest CBM player in India. In refining and marketing, we had record throughput at our Vadinar refinery of 7.28 million tons for the half year. And our expansion of the refinery, which will increase our margins, is progressing well. In June, the Government of India announced that it was deregulating gasoline prices and that it intended to deregulate diesel prices in the future. This is very positive for us as the largest active private sector fuel retailer in India, as it will increase both volumes and profitability as we can now compete on a level playing field with the public sector fuel retailers. Overall, we have made a lot of progress in the 3 short months since our IPO. On that positive note, I will now hand you over to Jerry to take you through some of our numbers.
Thank you, Prashant, and good morning, ladies and gentlemen. I'm going to take you through the financial highlights for the 6 months ending June 2010, with comparatives for the 6 months to June 2009. These have naturally been prepared under International Financial Reporting Standards, and being interim accounts are unaudited. We had strong revenue growth, up 66%, primarily due to a 20% increase in volumes at our refinery, and also due to the fact that the average refinery prices rose by 51%. Our EBITDA was down by $109 million, firstly due to relatively lower crude costs in the first half of 2009 compared to 2010, which benefited from inventory gains in that first half-year period. And secondly, retail profits of $32 million being available in the first half of 2009, which were not repeated in the first half of 2010. These two declines were offset by a $25 million improvement in power EBITDA. We shall explore the revenue and the EBITDA for both divisions in a moment. PBT was down around $80 million, mainly due to the lower EBITDA, but also higher finance costs of $25 million were offset by other gains, mainly foreign exchange, of $50 million. We've also introduced a current price EBITDA, where for refining only, we've calculated GRM and EBITDA after removing inventory gains, timing issues and tax duties to give a clean comparable measure as done by other international refiners. The current price EBITDA, which includes the power EBITDA, which has not been adjusted, is $333.7 million compared to $286.2 million in the previous half year, which represents a 17% rise. Our net debt was lower by $0.8 billion to $2.2 billion due to the IPO proceeds plus other shares issued to the promoters before the IPO, and after taking account of the operating cash flow of over $250 million in the recent half year, offset by the CapEx spent in the 6-month period. CapEx spent was actually $1.5 billion compared to only $300 million or so in the previous half year. Testament to delivering our rollout plans, which was fueled by our IPO proceeds. Our property, plant and equipment is now up to nearly $7 billion after depreciation, with $4.1 billion in oil, $2.7 billion in power, and the balance of $200 million or so in our E&P assets. Moving on to the divisional performance. The power financials are shown in this slide, and I'd like to just look at the revenue increase on the left-hand chart, which shows an 18% increase in the first half of this year compared to the first half of last year, principally driven by having a full year of operation of Algoma Power in Canada. The EBITDA margin was a very healthy 54%, up from 47% last year, and we had a 34% overall increase in EBITDA from $74 million to $99 million. So overall, a very good performance for power in the period under review. Moving now on to oil and gas, and we start looking at the left-hand chart, which measures the refining and marketing revenue. The throughput for the period was up by 8.8 million barrels, an almost 20% increase, which reached the highest level since operations began over 2 years ago. As mentioned before, the average refinery sales prices were up around 51%, which together with this throughput increase caused revenues to rise in oil and gas up by 68%. We've also presented a current price GRM and a current price EBITDA, which specifically strips out the timing difference of when sales were made and prices set, strips out the differences in inventory, it strips out the duty impact on crude oil products, eliminates hedging gains and losses, and separately identifies sales tax incentives. So in essence, each month we look at which crudes were processed, their associated fuel and loss, and which products were actually sold. We then review the crudes purchased and the current price at which those crudes were purchased after adjusting for our particular purchase premium or discount. That gives our current price cost. Next, we look at what was produced and calculate its sales value at the then current sales price in that month to give our current price of sales. The difference, therefore, is what we determine now as our current price GRM. So we've therefore removed all timing difference and duty impacts to set up a clear view of purchasing and production efficiency. And we can see, looking at the right-hand graph, that our current price GRM rose from $5.4 per barrel, including sales tax, last year, up to $6 this year. And indeed, our current price EBITDA, also in the bar charts on the right-hand graph,